We've got a bunch of great panelists again today. Um, Same group we had yesterday, plus one, which is really great. And we're going to get to a pretty interesting series of questions, somewhat connected to the last webinar. So you'll see some commonality if you were on that one as well. Just to set the stage a little bit, COVID obviously continues to evolve. And, as we talked about during the first webinar, we want to keep talking about how everybody engaged in this market, clients, buyers, sellers, renters, investors, whoever, can index where we are right now and use or continue thinking about the period as a way to either prepare for themselves for what they think is coming or educate themselves about where we are. The panel we have today, again, is a bunch of seasoned industry experts. Everybody's a leader in their field, and they have all kind of had a crisis event at some point already, whether it be Hurricane Sandy, 2009 financial crisis, 9/11, all three in my case. You have a group of people on the panel that have sort of been through a crisis. Every one of these crises is different, that is one thing I'll say. So they're not always immediately applicable, but everybody on the panel has been shot at. As before, the format of the panel is, or format of the discussion is a Q&A. I'm going to have some framing questions and some conversation starters, and we'll kind of let it go from there. I do ask you all to please use the Q&A link on the Zoom box to submit questions, not the chat panel. We're going to be using the chat panel on our own to guide the discussion, and we will get to as many of the Q&As as we can. What we aren't able to get to, I suggest, I encourage you to reach out to your Elegran salesperson to ask those questions, get to us, or we will bring them over into the next webinar that we do. We'll also follow up the webinar today with a very brief survey to gather your opinions on how we did today, what we should cover in the next one. Please take the time to let us know your thoughts, because we do these for you. So it's very important that we're on track and that we're providing information and value to you. Okay, so again, just turning to our panelists to introduce everybody. As for me, I've been a strategic advisor to Elegran now for about 2 years. I've got almost 2.5 decades now of working in middle market companies in CFO and COO consulting engagements. Started out working mostly on Wall Street on financial macroeconomic research for institutional investors, hedge funds, private equity, all that sort of stuff. I'm also pretty active in disaster relief as a liaison officer to FEMA Region 2. So that has provided a little bit of overarching perspective of the crisis that we're currently dealing with. Aboard, we also have Noah Rosenblatt. Noah is the founder of Urban Digs and offers a deep analytical data and highly customizable market stats to over 1,200 agents and their customers in New York. Noah is going to be focusing mostly on data questions and around supply demand, things like that. We also have Scott Vandermark aboard. He is Senior Managing Director at First Republic Bank, which is a publicly traded private bank and wealth management company. Scott is our macro guy. He'll be focusing on financing, credit, liquidity, things like that. We also have Ross Levine aboard, co-managing partner of Schwartz Levine. Ross is a founding partner of the firm and its predecessor firm, Schwartz Levine and Kaplan, and is co-managing partner of the firm's real estate department. He'll be obviously focusing on closings, transaction flow, legally, what's legal now and what isn't, what's possible now and what isn't. And then new on the panel from last time, we have Jared Anton. He is sort of the chief everything officer at Elegran, and he is our director of sales. He's also responsible for the professional development of the sales team at Elegran, and has tremendous insights into the actual activity, sale and purchase activity within the marketplace that we're all going to be talking about. All right. So, one thing let me get right into it. One thing we didn't really cover much, we talked about it tangentially last time, but we didn't really get into the nitty gritty of it, was the sort of, what's really happening. I mean, with the broad arc stuff, which we get to in a little bit today, macro and the New York shelter in place rules and all that stuff is fine. But what's really happening on the ground? what are the units on the market? What's happening with pricing? Like the factual sort of postcards from the bleeding edge of the crisis, which we wanted to sort of set the stage today with and lead with some of that information. So Noah, I don't know if you wanted to kick that off a little bit. What are you seeing? You know, supply, inventory, things like that.
Sure. Well, thanks for having me. Pleasure to be here.
Sure.
So number one, inventory is down. Inventory is down in Manhattan, primarily because we're seeing a significantly less amount of listings that typically come on the market for this time of year. That's pretty much the driving force. We also have off market. So there were listings that were active on the market pre-COVID and have since removed the listing off the market. But the biggest force impacting the decline in inventory is sellers just don't have any interest in selling. And I guess the main, thought process behind there is they don't think they're going to get their bids, and that's typically what happens. And if I think back, this is what happened in 2009 as well, So buyers are out there. They on one hand, they have the advantage of discounts and negotiability, but they don't have the advantage of supply, not nearly as much as they had going into this crisis, because they had inventory on their side for many years. And they had many options. They had sell side competition because there was oversupply, et cetera, et cetera. So that dynamic is going against buyers in the current market. And the market is dislocated. So when I look at supply, I see supply at 5,017. We probably should be somewhere over 7,000 right now. Oops. Oh, sorry if you guys hear my dogs in the background. Oh. This is
the FedEx guy just showed
real
up.
life zooming. So anyway, so supply's at 5,017 right now, and that's down about 39% from year over year, and we're supposed to be over 7,000. When I look at a week-to-week basis, we had about 82 listings come on the market last week. Now that's a Sunday to Monday look, okay? 82 listings. We should have around 450 come on the market. So that's what's going on.
Wow, so you're 20% of what you would normally see, not even.
Sorry, I didn't hear you there,
So
Steve.
you're a fraction, 10 to 20% of what the normal market velocity would look like.
That's correct. Everything, overall activity in general is just down tremendously. When you look at deal volume and contract activity, that's down about 80%. Mm-hmm. That's actually falling at a little bit of a lag. It took a while for the deal volume to fall because you had a lot of legacy contracts that were being signed. Right. So if you think about it, we're just getting into that period right now on a week-to-week basis where you're having mostly sight unseen pure Corona trades, not legacy residual deals. When I look at week-to-week contract signing, we only had 40 in the last week, and that's down 10% from the previous week. So weekly new listings is actually ticking back up. The weekly new listings was 82, and that's up 39% from the last week, which is a good sign. But weekly contract activity came in at 40. And that's very, very low, and it's continuing to go lower. And when I looked at it just now, that's on par for 35 or so. So it's even going lower. I think because, again, the residual deals are fading out.
Got it. Understood. So, Jared, can you hop in on there? I mean, obviously, there's a debate right now between, is this a buyer's strike or a seller's strike? What are you seeing on the brokerage side?
Yeah, so thank you. I'm happy to be part of this and join this panel. I think Noah's dogs chased away all the supply right there. But what we're seeing is sort of just, as Noah said, complete inaction, on either parts, right? 80% of the activity from a transaction side has been dried up. So what we're tracking when we're looking at in the brokerage community is what are the bid-ask spreads, understanding where are they today and where are people putting in bids and where are people accepting. And the most real-time data I can share right now is that we're seeing offers being submitted at an average of 14% less than the current ask. And the most recent data is also showing that sellers are also accepting offers on average 8% below the asking price. So that helps to give some immediate context into how motivated sellers are and how much of a deal buyers are trying to ask for today.
Okay. Yeah, we're going to get to bid and ask it a little bit later.
Steve, if I could just jump in one sec. On that note, I was going to say to Jared and Noah's point, I've seen a few contracts where a buyer feels that they got a very sweet deal and the seller feels that they got somewhat taken advantage of by the market, and that the timeline to sign is actually shortened because of the fact that there is that dislocated feel between the parties, and that it also could artificially drive up bidding wars for properties that are priced extremely aggressive. So I've seen 1 or 2 contracts where the buyer is instructed to sign pretty much immediately.
And I wonder to what extent that also helps drive further dislocation, right? Because if I know I've got to underprice something and I'm going to create a bidding war, that creates this sense of action when it really isn't market wide, right? This isn't like we can all, look at a tape on CNBC and see what the prices are doing. You don't see this stuff very quickly, right? So, I mean, let's take that sort of framework and that stage that we just described, that's sort of where the market is. Jared just described a bid ask that has gone almost like a floor lower, right? 14% offers, 8% asks, lower than list. So that whole thing has set down. Now, inside of this whole thing is happening inside of a macro environment. We didn't really talk a lot about the macro world last time because it's a pretty thorny thing, and we could probably spend the whole webinar talking about macro. At least Scott and I could probably spend most of the day talking about macro. What are your, I just want to do a very quick poll. You guys, everyone's reading a lot about, is it going to be a V-shaped recovery, a U-shaped one, a Nike swoosh? Let's just kind of go around the horn a little bit, and knowing what you know now and the markets that we're involved in right now, what does this recovery look like in New York? So Ross, let's start with you. What do you think?
I think that personally, I think it's going to go down a little bit further. There's my dog. And I think what's going to end up happening is I think it's going to have to hit a floor where sellers just can't take it anymore.
Right.
And it's then going to hit that cap where I was talking about before, where sellers are going to come out with less product, and that's going to drive up artificially, the demand price, right? So I think eventually we're going to hit that floor. I still think if inventory doesn't pick up and, with respect to the stay-at-home order being lifted, then we're going to have definitely more price drops. I think we need to see foot traffic, and then, Noah can have probably a better sense of where the market's going.
Right. Okay, that was a good handoff. Noah, what do you think?
Yeah, that was a very good handoff. And
Swish, what is it?
Yeah, somewhere between a V and a U. I mean, look, I already think we're bounced off the bottom, even though you're not going to see any of this stuff for 4 or 5 months.
Right.
And I'm going to probably get some slack here because, I mean, you got to remember, if you sign a contract 3 weeks ago or 4 weeks ago, when's that going to close? Right? That's going to take at least 2 to 3 months, probably 3 months to close. And then you got to wait for the city register to file that. So we're not going to get those sales. We're not going to get the true Corona fear trades or whatever you want to call them until probably August or September timeframe. At that time, the real-time sentiment in Manhattan is going to be quite different than what those sales are representing as the fear trades. So I got to be honest with you. The way I like to describe this is I think that we're in a dislocated period. And within that dislocated period, you're going to have more acute, severe, shorter windows of higher fear and dislocation. And I think that we've already had one of those short windows of more fear and higher dislocation back in the ending of March, 3rd week and 4th week of March. If you go back in time a little bit, Steve, you're a trader guy, just like I look at the market as a trade. S&P 500, we were at the depths of hell in like March 20th, March 21st, March 26th.
Now we're right back up again.
Right. And if you look at the market today, right now, I mean, fear level, we've rallied 25%. I'm not saying that we're not dislocated. We are dislocated, and there's barely any volume going on because the bid-ask spread is so wide, mainly because buyers have bid down the market. But I already think that we've bounced in the sense that the window where sellers are going to hit a gap down 20%, 25%, 30% offer. So if you're at $1 million and that bid's 750, right? The fear level, the window where that fear level is so high where that seller's like, all right, I got to get out and hit that bid.
Take it. Yeah.
Yeah, I think that may have passed a little bit, and we're in a different period of the dislocation now.
Understood.
And Steve, I'm going to just jump right back in real fast. And I think I talked about this in our last webinar. Interesting to note to see who is actually going to be listing, or is it going to be the people that are scared and need to just exit Manhattan and go to arguably a suburban area, or are there people that want to try to, I don't know, need money? You're going to see an interesting market too, where you have people that real Manhattanites that want to stay and stick it through, and those people may actually, the value of property may actually rise in a few years.
Right. Interesting. Scott, what do you think?
I favor a V, and I think, you know, the V is a function of you know, the fact that we're gonna keep going down here until we find a support level, you know, much as happens in the equity markets in moments of disruption. I think that you know, everyone's looking and grasping for what the right discount is, and the bid-ask spread, the width, the breadth of the bid-ask spread is reflective of how, you know, how confused the marketplace is. And I think in that confusion, there's real opportunity. So I think we drift down and down until we find that support level. I'm not sure where that is. I don't know if it's another 5%, another 10%, but as we're drifting down, you know, that reflects a tremendous opportunity
We used
for
to
the
look
for the
at
buyer
when the
community.
spreads would start to come in. That's when you knew people were over it, whatever it was, right? So if we start seeing that spread, that might be a good signal.
And there's going to be a moment, as happened after 9/11, which is why I think the V is we're going to get down to a level where everyone realizes all of a sudden what wasn't affordable previously becomes affordable for a certain segment of the first-time homebuyer community, or a certain segment of the professional community, you know, that are, you know, just in the process of ascending, you know, their ranks. And you know, the affordability of New York City real estate, I think, is one of the things that is going to be a jump off, you know, for activity and the climb back up in value.
And how steep the V is, really, right?
That's right. That's right. But I think we're not there yet. And I think we've got some drifting down before we get there. But now's the time to be out looking and finding those special situations, and lining up with your broker and being in the right place at the right time. If you're not in traffic, you're not gonna
see it. Yeah, I was just going to pivot over to Jared and ask him, like, Jared, what do you think? I mean, because it's in a liquid class, because the stuff lags, you know, the data, we don't have a tape with a print on it. The best source of whether that spread is coming in and what those prices are really doing is your team, right? Or people like, you know, the folks in the broker community.
Yeah, exactly. And this is part of the reason of that the brokers have this added value, right? Because Noah hit it on the head. The consumers, right, are generally 6 to 9 months behind what's actually happening because of the lag between the transaction getting inked and then it hitting the public record, right? The price is accurate as of the date that there was an agreement on the contract was signed. So Elegran's continuously monitoring all of the offer and contract sign data to track this bid-ask spread. So they're aware of this before it hits public record. And this means that we're able to respond to these trends and this information for our buyers and sellers in real time. And we've actually been able to negotiate and renegotiate deals based upon this. And I can share some examples as we go through today.
Okay, great.
But essentially what we're seeing is that there is some responsiveness. And I believe we should also call out that there's definitely a difference in what's happening in the resale market and the new development market.
Yeah, we're going to hit new dev down the road a little bit.
Great.
Hey, Steve, can I just say one? I just want to say one thing. You know, there's only been about 340 signed contracts since the shutdown order, and of that 320, I think it's very, very, very safe to assume that a little more than half of it, if not more, is probably residual legacy in some way, shape, or form. In the fact that they've seen it before the shutdown order, or they had an existing negotiation or an existing offer on the table going on. So if you think about that, there's only like 100 and some odd deals that are Corona deals. So buyers have to understand, you know, if you see everyone here is agreeing that in 4 or 5 months, you're probably going to see those numbers. If you wait 4 or 5 months and those numbers come out at that time, say in August or September, that's not going to be representative of the market at that time in August and September. You're going to miss it. You're going to miss it. The only way, like whoever the 120 buyers are right now, like those are the guys that are brave enough that are going to catch it, because you're going to go in there and you're going to bid 20%, 25%, 15% below wherever we were pre-COVID. And you're going to scratch your head wondering why, you know, sellers aren't hitting your bid. And the answer is that they don't have to. If they had to, we would see thousands of contracts coming in.
The liquidity would be in. Yep.
The liquidity would be in if you had to. They don't. So a lot of sellers can buy their time. So what buyers don't understand is they don't have the they don't have the inventory. And of the inventory that they're putting in 20% below, not every seller has to hit that bid that's coming down 15, 20%. So the buyer's like, you're wrong. The seller's like, you're wrong.
You're wrong. Yeah. And that's what Scott was saying about it. We have a little bit of time yet before this is going to have shaken itself out and everybody's kind of back to reading the same sheet of music. Before we leave this, we have a couple things we want to say. One is, Jared, do you see an ability can you get new pricing information fairly well as a broker from like the new dev community? I know we're going to talk about new dev separately shortly, but is there a difference in the information flow from that community versus regular resale?
To some extent, yes. The new dev is going to be a little bit more opaque. The developers are going to be a little bit more guarded of that information because
Right.
they're trying to control the supply to control the price.
Yep.
We do a lot of volume, and the brokerage community is sharing information on new dev, and we're tracking that separately. So we have more insight now than we've had before, but it's still less so than on the resale side.
Mm-hmm. Okay, great. And then before we leave the V or U or swoosh shaped recovery, we have a question in the Q&A. Let me just read it out and see what you guys think. If the movement is more like a check mark, prices go down sharply for a short period of time because everyone's nervous, and then a massive spike to elevated levels because everybody basically floods back in and they were all muzzled during the crisis. What's the poll in the group? You guys think that's a possibility, that we almost overshoot the other way?
I think it's a possibility if we can get, let's say there's a cure, let's say there's
Right.
a vaccine rather that comes out much earlier than anticipated, or, one of the Gilead miracle drug is,
Yep.
or is widely dispersed, then arguably come this notion of that the fall, we're all in a bad shape and that doesn't happen, then I think prices are going to dramatically go up,
Mm-hmm.
that the fear will be less. What's driving the market going down? Fear.
Right.
And obviously,
Right.
and a lot of death, unfortunately. Okay. But what the point being is, I think right now people are stagnant because they want to wait and see. So.
Yeah. What's the rest of the gang think?
See, that's really interesting, that check mark. I think if you reverse the check mark, that's like where we're at right now. We fell off the cliff and the COVID, and we've kind of bounced off the bottom a little bit. You know what I'm saying? And that's kind of where we are now. Now, where do we go from here? I think quite frankly, I think we're going to reflate. I hate to say it, but I think this is a Fed engineered environment. We've got $6 trillion in the States, 13 trillion globally. That's probably going to rise. We're probably going to see more plans, more phased infrastructure plans, and God knows what else. And that's going to just kind of goose hard assets. And I think you have an inflationary wave behind this. We got deflation now. We all know we got massive deflation now.
Massive deflation.
It's going to be ugly for a while. All the numbers are going to be ugly. But like Ross was saying, what happens if you get a treatment? There are a lot of scientific minds really going at the same
that is for sure
agenda here. And there's some brilliant people out there. So what if something good happens? What if we open up? Once you start seeing concerts get booked and Broadway come back and Madison Square Garden and sporting events, again, I think you missed it. But I think there's going to be an inflationary wave behind that. And I think that's when you're going to see all the activity come back.
Yeah, we could do a whole webinar on the inflation versus deflation thing, but just so everybody understands on the call, deflation is worse of the two. If you're a central banker and you're trying to manage the economy, you'd rather have inflation in this environment than deflation, because deflation means people are hoarding dollars because ostensibly they're worth more tomorrow than they are today. That's a much harder thing to uncork than inflation, which we haven't had much of to begin with, and we're certainly not looking like we're going to have it now. It's one of the reasons why the Fed has been able to act as aggressively as they did. The global financial crisis, we all thought inflation was going to come back after QE 1 through 5, and now here we are in QE 6, and it's going to make all the other ones look like a walk in the park. But we'll probably really dig into that maybe on a separate webinar if people really want to get into the weeds on the macroeconomic stuff. So we have a question in the Q&A. Just before we leave this again, are you guys all more or less in agreement that and I'm going to take myself out of this poll, that we believe the bottom is in? Do you think the bottom is in price?
You mean, do you think we're at the bottom right now?
Or we're past it? Because of the lag, is the bottom in terms of the price decline in Manhattan real estate? Or are we
the bottom and we're headed up from here?
More or less. That's the question. Do we sort of, as a consensus group, do we feel that way?
I do. I'll jump in right now. Not for commercial.
Yeah, not for commercial. Okay,
commercial's going to have a lot of pain for a long time coming. It operates at a different frequency. Yeah. But residential, again, I do think offers that were accepted March 20th, March 21st, 22nd, 23rd, 24th, 25th, going up to that, whose contracts were signed ultimately April 5th or April 10th or weeks later. I think those guys were doing a deal in an environment that was much more fearful than we're in right now.
So that'll be the nadir, right?
Yeah, that's not to say that you can't find a desperate, because it's highly illiquid, right? And if someone has to sell, it's just a matter of what kind of bid they can get. But I think what the problem here is that, again, you're going to bash me. The sales, those numbers are not going to show until
We're not going to see it.
August, September, October.
But if you're in the audience and you're thinking of putting an offer out, or you're trying to sell your place, that's good to know, right? If we think as experts that, okay, the pricing slide off the cliff may have found its bottom and we now need to kind of like figure out where we land, that's good information to have.
Reverse check mark.
Reverse check mark. What's the rest of the group think? Ross, Scott, Jared?
I do not think we're at the bottom. I think we've got more room to go, which to some extent is, you know, good news for buy-side brokers and buyers. I think that there's going to be more opportunity to get it while it's hot. I think that, you know, Noah, your commentary about commercial is interesting. I agree that commercial dislocation is greater right now than the residential dislocation, but the two feed into one another.
Right.
And as an example, I think the reason, I think ultimately, Noah, you're, you know, longer term, I think you and I agree, I'm probably, you know, 6 to 12 months behind you. I think it's going to take a little bit longer to, you know, start to arc back up. And as an example, you know, of how the commercial impacts the residential, you know, there are 6,000 new development units right now on the market, and 3,500 more coming to market in the next, you know, quarter to 2 quarters. So we'll have roughly 10,000 unabsorbed new development units that will be available for purchase. And the reason that those units, you know, developers of new construction have been able to hold their price to a greater extent than resellers is because there's been a tremendous amount of commercial loan liquidity in the marketplace. And so the advent of inventory lending has been able to allow developers to extend their facilities and not necessarily need to get honest on price. That is, to your point, Noah, about the dislocation in the commercial marketplace, that's going to ripple through to residential because that liquidity won't be available to those developers. Therefore, developers will have one choice and one choice only, and that is to reduce price to a level that will clear the market. So that's going to put downward pressure on prices in new development, which is a huge opportunity.
Which is a big, right?
The Elegran system that you know specializes in, among other things, new development, with a lot of buyers looking in the new development space. There is, you know, another, I think, you know, 5 to 10% off the original Schedule A beyond what developers have already conceded yet to go in order for that new construction inventory to start to clear out.
Really
So
start to clear. Understood.
A little bit longer, which is, again, buyer opportunity.
Okay, great. So I want to be careful of our time. I want to make sure we're moving along. So pivoting from macro a little bit over to the buy side, you know, we have sort of, obviously as a panel, we've got sort of a cadence involved or in mind for how we're going to move the webinar through. We've kind of covered some of the stuff we were going to cover later. So we might just stick here briefly a little longer. Ross, on the buy side, what are the obstacles right now? Like, what are people running into?
Well, you know, in seeing the apartment, right, from a tangible perspective, that they can go in and touch it and feel it and check the appliances, do inspections, you know, to be comfortable with the physical aspects of what they're buying, you know, and I think that has been a major impediment to a lot of deals happening, at least from my perspective. I've also seen, I'm getting calls daily from people who are terribly concerned about their future employment status and or income, and that they're, you know, afraid to take the leap of faith, if you will, that they're, you know, they'll have status quo into the future and be able to afford the apartment, or if it's a risky investment for them. And those are arguably the two major things that I've seen have been impediments to doing deals right now.
Okay. All right, great. And Scott, on the lending side, what's the delimiter on that side? Are people finding it difficult, even if they wanted to buy something, to get a loan?
We're seeing a lot of dislocation in the lending community. A lot of banks falling out on commitment letters, not being able to lend in certain new development projects, pulling back, you know, on certain lending guidelines. There's a liquidity shortage, you know, generally, and there's also a lack of a reduced reliability among some of the more traditional lenders that's making execution a little bit more difficult.
Right.
There are lenders that are out there reliably executing and closing, First Republic obviously among them. But the lending market has gotten choppier and a little bit less reliable, as would be expected.
How would you, just to stick on that for a second, do you find that that is one of those things that catches up to the crisis, so to speak? We saw that with 9/11, we saw that with global financial crisis, right?
For sure.
Yeah,
Right.
so
You know,
8 to
was
12
starting-
months from now, right?
There were hints of it a couple of weeks ago. It's now starting to get a little bit more consistent. You know, we're starting to get calls, throughout the day on deals that are falling apart that need to be put back together again. Of course, we're happy to do. And I think it's going to get worse before it gets better.
Yeah.
But there are premium, therefore, on making sure that you vet the broker, and the buyer, make sure that you've, vetted your lender, and make sure that, the commitment letter that make sure that you get a commitment letter.
You have one in the first place, right?
Don't be lulled into a false sense of security by a pre-approval. And, if you have a commitment letter, vet and re-vet that, the efficacy of that commitment letter with your lender to make sure that it still applies, hasn't expired, and is good and valid in the current.
And they're not going to pull it out from under you, right? Yeah. And I would imagine for the whole group, like mortgage rates where they are per se, isn't the first, determinant of the lending activity right now on either side. Mortgage rates could go up or down another 20 basis points, and it probably doesn't fix what you just described, Scott, or what Ross was describing.
Correct. Has nothing to do with rate.
Right.
Had much bigger drivers, to that dynamic.
Right. So that's for everybody on the call. That's another macro overlay. Is in a normal environment, macro would look a lot at the mortgage rates and where are they going and what's the right time and all that. It's kind of overshadowed in this world because it's not the primary driver of a lot of the.
Correct.
Okay. So again, trying to riff from there a little bit, Jared, tell us a little bit about inventory right now. We spoke about it at the beginning of the webinar about, things coming on board. We know the bid-ask spread is much higher. And we know there's quite a bit of juggling going on right now about where people really might want to live going forward. Can you chat with us a little bit about that?
Yeah, absolutely. So as Noah said when we first kicked this off, inventory is compressed, right? There's less inventory on the market, not because those things are sold, but because the sellers have taken them off. So they're what we like to refer to as shadow inventory. This is, again, another important reason to work with a broker that and you trust and that you can really develop a good relationship with, because the brokers are going to have access to all of this off-market inventory that you would to. And because of our relationships across the market, we're able to reach out to the broker, and we've been able to do deals off market at this time, right? Where the apartment wasn't publicly listed, but we're negotiating for a buyer and things like that. Also, a couple other just notes on this. Cash is king, right? During this time where the mortgage side is delayed and there's a backlog of refis and stuff like that, it's taking longer than ever to close on a mortgage, and there's some other risk for the seller. So those buyers that are coming in and putting cash to work now will be able to get a better deal than those looking to finance. And then the other note that's important is things that may not have been super valued before, or things that people would have been okay not having before. Let's take a view, for instance, right? So, someone that bought an apartment because they figured, I work 14-hour days, I'm just going to be here when it's dark to sleep. That brick wall that they've been staring at for the last 6 weeks is looking a little
tough,
old.
Right. That's a good point.
I would argue that the pricing disparity between apartments with light and views and those that are dark without views is going to widen during this time. I would also say that the value or the premium that a buyer would place on outdoor space will also increase during this time, right? Because light, air, outdoor space are some of the things that buyers may value more now that they'd have to consider being stuck in their home for a longer period of time.
And it'll be interesting, right? Because the price discovery that we talked about happening earlier with the bid-ask spreads, that's really what that is when we're trying to find a bottom. That's all about discovering where the price is. What you're describing are new inputs into the mix, sort of what drives value, right? So
Correct.
It'll be interesting to see what sort of premium gets attached to those. I mean, they've obviously, a room with a view obviously has always had a bit of a cachet, but maybe more now. And it may be harder to unload those that don't have that, right?
Correct.
You mentioned at the beginning of the webinar, you had some examples that kind of walk us through what you're seeing right now in terms of bids and spreads. You want to take us there for now?
Yeah, so I'll give you a couple examples. The first one's a condo in Midtown West. This was listed in early March for $1.15 million. We represent a buyer who submitted an offer for $930,000 last week, 20% off. Now, pre-COVID, we probably would have advised the buyer that submitting something that low would have really shot yourself in the foot and been not a good starting point to negotiate, right? A classic lowball offer. But all of those rules have sort of gone out the window now, and lowball offers aren't really lowball. We saw an offer as low as 43% off the asking price 2 weeks ago go out the door. But in this one example, the seller actually countered at 7% off, so $1,070,000. And the listing broker basically told us quietly that she believes the seller will ink a deal at $999, which is 13% off. And that's a financing deal, not even a cash deal. So that's an example of something that was listed recently, not even on the market for 6 or 9 months, something that's been on the market, 2 months, and that's still under what the average was and is moving out. Another example of us being able to leverage this information and actually renegotiate a deal, Sudden Place, a $1.15 million asking price on a co-op. We ultimately inked a contract for $999, a 13% discount. This contract was signed at the end of March. But the original accepted offer was 1.1, and this was accepted early March, so pre-COVID, pre-lockdown. And basically, the buyer asked for a 2-week pause. He didn't want to sign the contract. He wanted 2 weeks to see how COVID would play out and figure out whether he wanted to proceed or not. And the seller came back and said, we'll give you $100,000 off, so another 10% drop to sign a contract within 4 days and don't take the 2 weeks. And the buyer inked it, because the reality is the apartment, in my opinion, is not inherently worth 13% less than it was,
right.
2 days
2 months ago. Yeah.
So that's a dislocation right there. So again, being able to leverage the relationships and the insights that we can bring allows savvy buyers or those that are comfortable enough in their financial situation to potentially take a risk now and ink a deal that gives them.
And for the seller to offer somebody $100,000 to move, to not wait 2 weeks, that's it tells you a little bit too of the motivations that both sides are dealing with.
Correct.
Interesting. Cool. Now let's pivot this. Well, hold on. Before we leave macro, we've gotten a bunch of questions around what we as the panel think, the New York City situation is going to look like. Unemployment, their budget is busted. What does it mean for taxes in the city? Before we leave the macro environment that these transactions are living in, very quickly, I want to kind of get all your senses around how we think, say there is no second wave. Let's cross our fingers. There's no second wave. We don't have to go back to social distancing. But every municipal budget in the country, and certainly New York's, is busted. How is that going to play a role in the longer term recovery of the market? Scott, I'll start with you.
So, I am born and raised in New York City, and I'll give you a very visceral gut level, response, which is, I live in New York City. I own in New York City, lived through 9/11, 2008, and, the ups and downs of Manhattan, high taxes, crime, a whole variety of challenges that Manhattan has, faced over the years. And my, unabiding, commitment to New York City and love of New York City, has, over the years, served to make me impervious to all those things. I mean, I'm just a New York City bull, and I think there are a lot of New York City bulls, and I think there are a lot of people who just want to be in New York City and need to be in New York City and wouldn't consider any other lifestyle, regardless of what it costs to be here, regardless of, what other challenges might exist at the time, vertical density included. And so I think that, we come out of this and we're fine and we're stronger. And, New York City continues to be New York City.
Okay, great. Ross?
Yeah, I mean, I would just not be so focused on New York City in the sense that, remember, this crisis, as much as it hit New York City hard, it absolutely hit Westchester pretty hard.
Yep.
It hit pockets of Long Island. I mean, it's not just New York City, right? So to think that the city will suffer, you know, far worse than these other areas, I think is a little bit misguided, quite frankly. So I tend to agree with Scott. I mean, will taxes increase? Potentially, but quite frankly, when I represent clients, one of my classic remarks is that taxes always go up, you know,
Right.
so they're going to go up most likely with inflation anyway, you know, so, well, you know what I mean, with in terms of cost, operating costs going up. So I tend to believe that I don't think it's going to be dire situation. That's my opinion. I think they're going to have to come up from a state of New York standpoint to come up with more cash. And I don't think it's necessarily going to be, let's pick on the real estate industry again. I think it's going to have to come from a lot of different avenues, perhaps maybe liquor and beverage distribution and things like that. I've heard about other states trying to increase taxes on liquor.
One thing I know that probably is not a good thing to flare on this call, but the idea of getting some sort of tax on securities transactions for New York City has been revived in some places. So that's one thing that I think people are like, oh, that might be a new one that we've been able to hold off for a long time, but on the other side of this could be problematic. I mean, I'm just looking at some of the numbers. There's real holes in the municipal budgets now that they're not getting sales and use taxes. They're not getting retail taxes, things that we use to plow roads in the winter, right? Those are real life holes in the ground that we're going to need to get filled somewhere. And I agree with Ross. I agree with both of you guys. It'll be New York will bounce back, but it will require a mix of efforts. It's not just going to be taxing, you know, people who have pied-à-terres. Noah, do you want to hop in on that?
I mean, yeah, sure. I mean, the city's gonna be fine. I mean, look, I mean, I am a New York City bull.
Right.
The city's gonna be fine. You might have to deal with a lot of empty retail for a little while. But I mean, we've been through 9/11. We've been through the Great Credit Crisis, which was a Wall Street phenomenon that killed us. We came back from both. We've been in a 5-year progressive deflation before COVID hit. I mean, people sometimes forget that. It's not like Manhattan was on an upswing and at a peak when COVID hit. We were at the downswing of a 5-year progressive decline that was a policy-driven reset. I mean, you had everything thrown against the Manhattan market that would hurt it. You had the SALT deductions constrained. You had the rental, the townhouse market, the rental cap hikes. You had the mansion tax increased. So all these things were affecting our market, and we were about to come back. We were coming back.
And then this thing hit.
Market was coming back in 4 months. I think it's going to be fine. I mean, the Fed is backstopping munis. The Fed's going to backstop everything. Again, it's not about right or wrong. It is what it is.
That is definitely true. Fed is going to backstop everything. We've never seen a Fed like this.
I wanted to jump in real fast too. You know, I will say that a lot of people, you know, are always talking about, oh, I can easily work from home. Oh, look at the remote world now. But I actually beg the question to my fellow panelists. How many of you feel that you are as productive working remotely compared to when you're in the office?
Not even close.
Not even close.
Not even close.
So the whole remote notion, in my opinion, is done. You know, I think it's definitely somewhat effective to keep kicking the can along, but no way do I feel, especially with my staff, is nearly as productive as being in the office.
Right. So these concerns that this is going to put a bullet in the head of every commercial real estate owner is probably premature, right?
I think so.
I totally agree with that. I'll give you one very specific anecdote just because it's so specifically relevant to Ross's observation, which I completely agree with. I was talking to a senior executive at SL Green the other day who polled all of his largest tenant CEOs to figure out where their head was and make sure they were paying their rent next month, and then also to just, you know, get a pulse check on how they were feeling, because SL is the largest office landlord in the city, and 99% of the CEOs responded that they were miserable with the remote regime.
That's interesting.
The 1% of their workforce that would find a way to be productive if they were on a desert island are still productive, and the 99% of the rest of the workforce are on paid vacation. And the faster that they could get back to the office, the better. And I think therein lies the truth about what will happen. And there's a second beat to that drum, which is that there will be some migration to remote. So there'll be some reduced capacity, perhaps for some segment of the workforce, but that will be offset by spatial requirements within every office layout, because no longer can you pile, my analysts in the office are piled on top of one another.
You can't have a cubby farm,
To
right?
do that. That floor plan is going to have to get redone. And so what you
Understood.
lose, in remote workforce, you'll pick up through spatial realignment.
All right, great. Jared, I'm gonna assume that you're bullish on New York as a broker, so I'm gonna move on. We wanted to talk a little bit about new dev in the time we have left. We didn't get to very much of it back when we had the first webinar, and it may be a topic that we carry over to the next one again as well. But let's narrow in a little bit on the new development, new construction market a little bit. Jared, what are you guys seeing pricing wise there? What's the impact on, I mean, there was a lot of inventory already. How do you see this shaping out over the next 3 to 6 months?
Yeah, so it's definitely developer by developer, right? And it really depends on, how overbuilt or overinflated their pricing was, right? I mean, I was talking about before, new dev is an overinflated, overbuilt ball of wax, different than resale. And the big issue there is we don't necessarily know exactly how much inventory there is, right? I mean, we have some sense based on how many permits were filed for how many units and what's sold, but it really depends developer by developer, and it depends on how their pricing was. Right now, I can tell you that, we just negotiated a new dev deal in Tribeca for 17% off the asking price.
Wow.
Some new devs are advertising, 10 to 20% off, their most recent pre-COVID asking prices. I'll tell you something else that's really interesting, and I personally hadn't seen this in New York, but something nationally that some developers have done is basically insert a clause in the contract that says if your home and your model basically is advertised for a lower price between contract signing and closing, your price will be reduced. And we actually negotiated a deal for a national developer in New York City where we got this clause in the contract.
It's almost like Best Buy, right? Find an advertised lower price and we'll match it.
So the last time that I understand that this was used based upon research and speaking to people was in Brooklyn in 2008. So we're going on 12 years and not in Manhattan that this clause has been inserted. And that protects the buyer from, risk between contract and closing that prices continue to go down. So the reality is working with a good broker, understanding all these different tools, buyers have a lot more negotiating power and a lot more different clauses that they can put into deals now, whether it's funding contingencies or this, decrease in price contingency, that de-risks some of the transaction for them today.
But for the sponsors, right? I mean, this has always been a thing, right? They're always so hesitant to actually lower price per se, and they flare it by, or they bring it aboard with concessions and things like that. I mean, Scott, the crisis must be doing a doozy on all of the sponsor leverage and the lending that they've got out there. Where do you think that threshold lies with the sponsors and the lenders? Are lenders in a position with some of these big developers where they say, listen, you got to price differently, or push some of these unsold units over to rentals, or do they not care as long as their debt's being serviced?
No, I think what's happening specifically is deals are getting recapitalized. I think there's a lot less liquidity available to that marketplace.
Right.
It gives developers fewer options. The fewer options, will include recapitalizations where the equity gets crammed down to zero, and you've got a different decision maker. The debt is now making the decision, not the original owner.
Right.
And the debt doesn't care about, the equity's wiped out. So the only thing the debt cares about is getting repaid. And the last dollar on the debt might be $1,200 a square foot, $1,100 a square foot.
Right.
Right. The original Schedule A was $2,000 a square foot, but the last dollar on the debt is $1,200. So and that's now driving the decisions on what sale prices to accept and what sale. So different sheriff in town with lower price expectations, they don't have to get the Schedule A. They just have to get their principal repaid.
Right.
So
right. And they care more about LTV in this market, probably, right? Like they want to make sure their collateral is still valuable.
That's going to push. That's going to create a more more realistic price regime in the new development space. And will help to start to clear out all of the 10,000 units of new development inventory, $35 billion, of inventory, that has accumulated. There's going to be great opportunity as those recaps start to force better prices. There's going to be great buying opportunity in the new build space. That's going to unfold over the next 6 to 12 months.
All right, awesome. So, we talk a little bit about new dev, and we talk a little bit about how the macro world is going to push some of this stuff around. I wonder a little bit about how much you guys believe, the inventory-led crunch that we sort of started with. I think that bounces back over time. It's a question probably for another time about how quickly that happens, but how do you guys feel this should be indexed relative to the rest of the country? Where New York is a very special place. We've already talked about that a lot of times. Is there trends that you see here that are really not happening in the rest of the country? Or do you see things pretty much, is New York a microcosm about the way the rest of the country is going to develop?
So I can start here. I think one of the biggest differences between New York and the rest of the country is the rest of the country over the last 4 years has been appreciating. They've had, relatively little inventory. New York is going the opposite. There's a lot of building. There is actually a lot of inventory. It's just not on the market right now, but there's a lot of sellers out there. And we've had, as Noah talked about, 4 years of price, pressure, downward price pressure. So New York has been having a drastically different last 4 years than the national average. And keep in mind, New York is an international destination. I really do believe on the aggregate, people's memories are short. Right. So, people say, I don't want to live in the city. I don't want to be dense, but you give them 6 months on a farm, they're going to be itching to come back into the city once life comes back. And that's going to bring back
pizza, coffee's terrible.
We're seamless at 2 a.m. The bars are all closed. But that's going to bring back the international buyer and the other people that want to put money in here. Right. We're still seeing deals get done from international consumers that are buying as a diversification and investment play now. So
there's a whole webinar we're going to maybe think about doing on the use here now as a hedge, illiquid asset, place to park cash. Is it safe? All that. There's some really interesting international investment angles in the world we're going to be in after the bottom is found. We have 5 minutes before our close time. There's just a few quick questions that I wanted to get to. Obviously, we're not going to get to everything we were going to talk about today, but that's usually the way it goes. Do we feel as the group that the Fed's move, let me rephrase the question. I think I'm paraphrasing the question a little bit. The Fed will be as accommodative as it needs to be for as long as it needs to be it. Like we've seen a little bit with the pricing kind of coming down a shelf, not just trickling down, but coming wholesale down a level. Do you feel that real estate activity and transaction activity also stays at that lower shelf level as long as rates stay down? In previous crises, did you see those two things correlated? So market started to get back to normal once Fed policy started getting back to normal, or are they not correlated? And we'll just do a lightning round around that one. Ross?
I think they are somewhat correlated. I mean, I remember after 2008, the market blossomed because of the fact that borrowing money was so cheap.
Right.
But ironically, and I'm sure Scott can attest to this probably a little bit better than I can, but I've heard from a lot of clients who are rate shopping, rates they may be low, but they're not terribly low. They're not, it's not a 1-to-1 ratio. So if the Fed could keep things somewhat stagnant, I think it will help generate a little bit more activity in the market, but I don't know if it necessarily is 100% direct.
Right, it's on the margin then. All right, great. Scott, do you concur?
I do. I mean, so your Fed fund zero doesn't correlate to 0% mortgage interest rates. There's, banks' marginal borrowing cost is higher than that. Plus, you have the cost to manufacture the asset. So whether it's 1.50 or 2.0, as to sort of the break even.
There's some floor there. Yeah.
So there's a level below which it'll never make sense for banks to lend, unless they're just trying to buy market share, which can happen from time to time.
Or the Fed will buy the paper back, like we're seeing with the small businesses, right?
Right. I do think that the Fed is going to continue to pump, stimulus to such an extent that, we'll probably see low interest rates as the economy, as real assets start to reinflate, including New York City real estate. There'll probably be a beautiful moment where, that the reinflation is happening, but you can still borrow at amazingly low rates and are both pieces.
Right. Okay, great. Noah?
Yeah, I mean, I don't know what we should be comparing it to, because this is just completely unprecedented in terms of Fed response. I mean, the 2009 crisis, they put about over $1 trillion and one point something trillion. We're up to 6.5 trillion.
Right.
And that's probably
And
going
we're
to
only
10
6 weeks in. That other trillion took what, a year and a half?
Yeah, that took, they acted really, really, really fast this time. And look, I don't think they even started buying corporate bonds yet, in terms of monetizing the debt and QE and all that stuff. I think that's yet to go in. It takes years. They're stimulating a search for yield is what they're doing. They're trying to get risk assets to go out there and artificially boost assets. And rates aren't going anywhere. They're just going to go down. I wouldn't be surprised to see our short-term treasuries go negative again. I know they're trying not to let it happen. We're the world's reserve currency and all that stuff, but we're facing tough times, deflationary, and the Feds, they're trapped. They're going to just keep doing it to boost us out of this
and keep us moving. Right. There's a movement premium that we learned last time, that we have to keep the engine rolling at any cost. Really, we can't let it seize. That was part of the problem with Lehman and a bunch of others. All right, guys, I'm gonna hold it there. We're at our time. We've got a few minutes left. I want to remind everybody the webinar is recorded, so this will be sent out to everybody. If you have questions and you have follow-up ideas, or this is sparking something that you'd like more information about, email us, reach out to your Elegran salesperson, find those people, get those questions answered, and we will do our best to answer them. We'll also try to go through some of the ones that are on the Q&A here. I think we hit most of them at least obliquely, if not directly. And if we didn't, please circle back with us, or we'll try to bring some of them over into the next one of these. Please do the survey. It's going to appear on your screen in a moment. Please stay tuned to future emails. We're going to be doing more of these webinars. We've got a pretty good cadence going right now, and I hope everyone is finding this valuable. I certainly am. I love talking about this stuff. Thanks again to all of our panelists. You guys are great, and we all have a tremendous amount of knowledge and information, and I'm psyched to be with you guys to be able to share it. Thanks for coming. And put on my female liaison officer. Please stay safe. Please continue to follow the guidelines and the restrictions as they're being lifted. Let's do this right, play it safe, and everybody take care. We're launching the survey now. Thanks.
Bye, everybody.
Thanks, everyone.